Starting a business is tough. Money and guidance can come in handy. Angel groups can provide the help startups need to get off the ground. Angel groups are made up of high net worth individuals. They invest their own money in promising startups. They are not just looking for a return on their investment, they are looking to nurture the next generation of successful businesses. They provide more than just money, they offer guidance, mentorship, and a network of contacts. Only about 10% of startups succeed. Angel groups can significantly improve these odds. Angel groups might seem like exclusive clubs, but their structure is designed to be accessible and efficient. Understanding this structure can help entrepreneurs navigate the world of angel investing more effectively. Most angel groups are formally organized. They have clear membership criteria and investment guidelines. They operate as either a limited partnership or a limited liability company, or LLC. This legal framework protects both the investors and the startups they fund. A typical angel group has a management team. This team usually consists of experienced investors, business professionals, and successful entrepreneurs. They manage the group's operations, including deal flow, due diligence, and portfolio management. Many angel groups specialize in specific industries or investment stages. Some focus on technology, healthcare, or consumer goods. Others prefer to invest in seed stage, early stage, or growth stage companies. This specialization allows them to leverage their expertise and provide more targeted support to their portfolio companies. Many angel groups invest regionally. As of recent data, there are over 600 active angel groups in the United States today. Angel groups typically invest $250,000 to $750,000 per deal, with individual members of the group investing $25,000 to $100,000 each. But angel groups bring more to the table than just funding. They offer a unique set of benefits. One of the biggest advantages is mentorship. Angel investors are very often successful entrepreneurs themselves. They have a wealth of experience and knowledge to share. They can provide invaluable guidance on everything from creating an investor deck to perfecting the business model to planning a marketing strategy. Angel groups also provide access to their extensive networks. This can open doors to potential customers, partners, and prospective future investors. These connections are worth investing time in. Beyond mentorship and networking, angel groups can also provide credibility and validation. Having a reputable angel group invest in your startup is a strong signal to the market. It shows that your business has been vetted and deemed worthy of investment. This can attract further investment, talent, and customers. Startups funded by angel groups have a significantly higher success rate, with nearly 25% reaching a successful exit compared to just 10% of those without such backing. Not all angel groups are created equal. Just like finding the right business partner, it's crucial to find an angel group that aligns with your startup's specific needs and goals. Start by researching a few local angel groups. Look at their investment focus, portfolio companies, and track record. Networking is key. Attend industry events, conferences, and workshops where entrepreneurs, angel investors, and members of the groups you are interested in are present. Talk to other entrepreneurs and get their recommendations for angel groups that might be a good fit. Be selective. Partner with an angel group that understands and shares your vision and can provide the specific kinds of support you need most. This is a long-term relationship, so choose wisely. Angel groups prioritize the founding team's experience, market potential, and uniqueness of the product or service. So you've found an angel group that seems like a match. What's next? It's time to navigate the application process. Most angel groups begin with an online application process through their website. The process has several stages. They may start off by asking some fundamental questions designed to assess your startup's potential and fit with the group. Then, you will need to submit detailed information about your business sooner rather than later. This includes your business plan, investor deck, financial projections, and team background. Be prepared to answer questions about your market opportunity, competitive landscape, and go-to-market strategy. If your initial application is successful, you'll likely be invited to pitch to the group. This is your chance to bring your business to life and convince them why they should invest. The angel group will want to do their due diligence and verify the information you've provided. They may also conduct background checks on the founders and assess the market opportunity. Be prepared to answer their questions thoroughly and honestly. On average, only about 10% of applications are successful. Common reasons for rejection include lack of market potential, weak business model, and insufficient team experience. Partnering with an angel group is not free. There are costs involved, and it's essential to understand them up front. Transparency is key in any investor relationship. One of the primary costs is equity. Angel groups invest in exchange for equity in your company. This means they will own a percentage of your business. The amount of equity they receive will depend on the size of the investment and the valuation of your company. Some angel groups may also charge fees. These fees can cover due diligence expenses, legal costs, or ongoing management fees. Make sure you understand all the fees involved before you sign any agreements. Remember, giving up equity is not just about the money. It's about bringing on partners who can help you grow your business. Choose your investors wisely and make sure the partnership is mutually beneficial. The average equity stake taken by angel groups ranges from 10% to 25%. Additionally, fees can vary widely, with some groups charging up to $10,000 for due diligence and legal expenses. Understanding these costs can help you make informed decisions and plan your finances effectively. You've got your foot in the door. Now it's time to wow them with your pitch. This is your chance to sell your vision and convince them that your startup is worth their investment. Your pitch should be clear, concise, and compelling. Start with a strong hook that grabs their attention. Clearly articulate the problem you're solving, your solution, and your target market. Highlight your competitive advantage and what makes your business unique. Don't be afraid to be passionate. Investors invest in people as much as they invest in ideas. Let your enthusiasm shine through and show them how much you believe in your business. Practice your pitch beforehand. Rehearse it until it feels natural and conversational. Be prepared to answer their questions thoughtfully and directly. 65% of successful pitches start with a compelling story, and 80% of investors are more likely to invest in startups that demonstrate a clear market need. Additionally, 75% of angel investors prefer pitches that include detailed financial projections and a strong business model. Ever wonder what goes on behind the scenes of an angel group? Their day-to-day operations are a mix of reviewing deals, conducting due diligence, and supporting their portfolio companies. A significant portion of their time is spent screening potential investments. They receive numerous business plans and pitches each week. They have a rigorous screening process to identify the most promising opportunities. Once a startup has passed the initial screening, the angel group will conduct due diligence. This involves verifying the information provided, assessing the market opportunity, and evaluating the team. Angel groups also play an active role in supporting their portfolio companies. They provide mentorship, guidance, and access to their network. They may also participate in follow-on funding rounds as the company grows. Angel groups have an operational efficiency rate of around 70%, with successful investments yielding an average return of 2.5 times the initial investment. What types of funding can be expected from angel groups? Angel groups provide various types of funding to startups, depending on the stage of the company and the investment needs. Understanding these different funding types can help you determine the best fit for your business. Seed funding is the earliest stage of funding. It is typically provided when a company is just starting and needs capital for product development, market research, or initial hiring. According to recent data, 60% of angel group investments are in seed funding. Early-stage funding is provided to companies that have developed a product or service and are generating some revenue but need additional capital to scale their operations. This type of funding accounts for about 30% of angel group investments. Bridge funding is a short-term loan that bridges the gap between two funding rounds. It represents approximately 10% of the funding provided by angel groups. This is often used by companies that are close to securing a larger round of funding but need additional capital to reach a specific milestone. While partnering with an angel group can be incredibly beneficial, it's essential to be aware of the potential challenges and pitfalls. Going in with open eyes can help you avoid common mistakes. One potential challenge is dilution. Studies show that 60% of startups experience significant equity dilution after receiving angel funding. When you accept funding from an angel group, you give up a portion of your company's equity. This means you'll have less ownership and control as your company grows. Another challenge is managing investor relations. Around 45% of startups report difficulties in maintaining effective communication with their angel investors. Angel investors are active investors, and they'll want to be kept informed about the progress of your business. It's essential to establish clear communication channels and provide regular updates. disagreements can arise. Angel investors may have different opinions about the direction of your business. Approximately 30% of startups face conflicts with their angel investors over business strategies. It's essential to have a clear understanding of their expectations and be prepared to have difficult conversations. Remember, finding the right angel group is like finding the right business partner. It's about shared vision, trust, and a commitment to mutual success. Choose wisely, nurture the relationship, and watch your startup soar to new heights. Statistics show that startups partnering with angel groups have a 25% higher success rate compared to those that don't. So, if you're a startup looking for that extra push, consider reaching out to an angel group.